I think there are three parts to getting forecasts correct. The first part is science. We use a well-constructed model that uses good theory. The second part is experience. So we've been watching the economy for a long time and know when things are going awry. And the third thing is a big dose of luck. And so we're happy to have that as well. So some of the indicators that we use, certainly financial indicators help us because it reflects the collective wisdom of market participants and their assessment of where the economy is going. Markets don't always get it right, but there's a good signal that we get from watching asset prices and interest rates in terms of the health of the economy. When we look at the underlying economic data, we certainly like hard data as opposed to soft data, surveys and so forth. So industrial production is key, employment is key, and one of the reasons that the Employment Situation Report, which is released the first Friday of every month, is absolutely key is because it's one of the best, earliest indicators of the current state of the economy. And we know that employment is more a lagging indicator than a leading indicator, but still it gives a very good sense of where the economy is sort of right now or in the recent past. We also look at purchasing manager indexes. My own company, IHS Markit, we all are well aware of the market PMIs that are available for the US and many important global economies. And it gives us a really good sense of where the economy is right now, in addition to the employment indicators. So that's those are some of the key things that we like to look at. And of course, you know, the health of the consumer sector. There are many indicators there, and given the importance of the consumer sector in the economy, you know, if the consumer is healthy and spending, the economy is going to be doing well. If it's not, the economy is not going to be in great shape. So our baseline outlook for the U.S. is for continued growth, modestly above trend. We put trend or potential GDP growth at about 2%. So we're looking for growth at 2% or a little bit higher over the next year to 18 months. After that, things get a little bit sketchier, a little bit harder to call. And in large measure, it is because the consumer is in such great shape. Whether you look at employment, income growth, increases in wealth through stock market, home prices, everything is basically hitting on all cylinders. Probably the best environment for the consumer sector in at least 20 years. So it would be surprising to see a significant pullback in consumer spending. It would take some sort of major confidence shock that we just don't see right now. So obviously the job market is exceptionally good. Unemployment rates across all groups are low. The overall unemployment rate around 3.5%. The question is, can it go any lower? Probably not too much lower, just because there's normal turnover, there's a mismatch between job needs and skill characteristics of the workers. So things are good. In part because the unemployment rate is so low and the market's so tight, we are seeing the growth of employment slow. So I think we have to get used to seeing what we would call a one handle, 100 something, in terms of average monthly payroll gains, probably in the year ahead on the payroll side. In the private payrolls, about 125,000 average over the next year or so, which is quite a bit below what we've seen in the recent past. The Census Bureau will be hiring about 350,000 workers over the next 9 months or so, 6 to 9 months, as it conducts the decennial census in the United States. And those are temporary jobs, so they'll be shedding those workers in the second half of 2020. So when we look at overall employment, including government, it will look pretty good. But private employment gains probably averaging about 125,000. So the market is still good. Jobs are really plentiful. It's amazing when you drive around. You don't see a lot of old beat up cars anymore. Basically everybody has a new car. Might not be a Mercedes or a BMW, but they're driving a new car. Obviously the importance of the Chinese economy in the global setting is paramount. And so any insights we can get about policy moves that will be occurring in China and whether they're likely to be effective are always important. stepping back, how is the transition from an investment-led to a consumer-led economy going? Is it going according to plan? Is it ahead of schedule, behind schedule? And what are the policy changes that are meant to facilitate that transition? I mean, there's a natural transition as income levels rise, but what is being done to help facilitate that transition, I think, is really important. And then, the 900-pound gorilla in the room is what's going to happen with trade policy. The tariffs that the U.S. has implemented and the countervailing tariffs, in terms of their direct effect on the economy, have not been great because of currency changes, because of trade diversion, because of compression of margins. It hasn't been a big factor in the U.S. economy, and the direct effects probably are lost in the rounding for the most part. Nevertheless, there has been some reduction in business fixed investment tied to the uncertainty around trade policy, but again, it's not a huge amount. More likely to have been impacting the economy are the more indirect effects. So whether it's business confidence hits volatility in financial markets that we see every time there's a new tweet that comes out of the blue and brings about some sort of new expectations for policy or adds to policy uncertainty. Those are the kinds of things that have also held back the U.S. economy and probably the global economy to some extent. For those who are about to graduate, I'd say it's a great time because the market is fantastic. I think if you trained in financial services, there may not be as many financial services jobs as there were in the recent past because of some rationalization that's occurring within the financial services sector. So it will still require hustling, in that job market. But generally, it's really quite good. And the other thing that I think people should consider since it is a finance association, most of these folks probably have some sort of finance degrees, that they should look also outside of financial services. There are lots of finance positions in non-financial companies as well. So I would certainly broaden the search. Everybody likes to work for Goldman, right? I tried to hire a young MBA graduate from Washington University's Olin School who was Chinese, and she had interned for us, and she loved the company, and she seriously considered the offer, but her parents said, well, eventually we want you to come back to China, and we know that Goldman Sachs has an office in China, but Macroeconomic Advisors doesn't, so it influenced her decision to take the Goldman job.